Hello everybody, my name is Richard Arias, and today I will be analyzing 3M Company's financial statements. First, a little bit of background. Any company has a management goal, and the goal of management is to maximize stockholders' value. In order to maximize stockholders' value, future cash flows must continue to grow. In order to grow our cash flows into the future, a financial statement analysis can be very beneficial. Doing this, we can analyze past and present performance, and this will give us clues so we can make informed decisions that affect future performance of the company's stock and fundamentals. Cash and liquidity. As of December 31st, 2009, 3M had cash and equivalents of $3.04 billion. In 2008, cash and equivalents were $1.85 billion. So year over year, this is an increase of $1.2 billion, which greatly improves 3M's liquidity position. This gives 3M the ability to pay bills, dividends, start new projects, etc., which has a positive effect on liquidity. Inventory costing. 3M uses the lower value of either the cost or market. When using cost, pricing is determined by using FIFO, which is first in, first out. FIFO dictates that the oldest inventory is used first. It also dictates that the cost of the inventory on the income statement will be the same as the cost when the inventory was first purchased. There are other costing methods such as LIFO, which is last in, first out, or an average of the two, but 3M chooses to use FIFO. Total common equity, also known as net worth. On December 31st, 2009, 3M had net worth of $13.3 billion. Same time a year ago, net worth was $10.3 billion. There is significant growth here, which is favorable. This growth also signals expansion, which indicates that the market cap is growing. Operating income. From the income statement, we can see that on December 31st, 2009, 3M's operating income was $4.8 billion. In 2008, same time, operating income was $5.2 billion. This is a decrease of nearly $500 million. This can be attributed to lower net sales that were down by $2 billion in 2009 from 2008. And this can also be attributed to the economic crisis of 2008. Net income, PE, or price to earnings ratio, and PEG ratio, which is price to earnings to growth ratio. In 2009, 3M had net income of $3.2 billion. In 2008, 3M had net income of $3.5 billion. The net income figures shown here indicate the amount of income that is available to shareholders. In other words, this is the amount that's left for them after all expenses are paid. So this is the amount that they have a claim against. So in 2009, shareholders have less income that they can have a claim against. Moving on to PE ratio, in 2009, PE was about 18 versus 11.5 in 2008. The PE ratio is a measure of relative value. So in this case, from 2008 to 2009, the PE going up to 18 indicates that the stock is more expensive. Also, another way to look at PE is that this is how much an investor would have to spend per dollar of earnings. Moving on to the PEG ratio, this is also a valuation measure, but it puts growth into the denominator so we can get a better feel for value. In general, investors like to see a PEG of 1. In 2009, 3M's PEG was negative 2.3. In 2008, it was negative 0.88. This decrease in the PEG ratio indicates that earnings are down. Earnings per share. Earnings per share takes total profits and divides it by the number of outstanding shares. So basic EPS for 2009 is $4.56, and in 2008 was $4.95. So we have a decrease in basic EPS. Diluted EPS. In 2009, diluted EPS was $4.52, and in 2008, $4.89. The diluted EPS figure is lower because this accounts for convertible stock, stock options, warrants that could be issued if the holders wish to exercise that option. So from 2008 to 2009, we can see that earnings per share are down, indicating lower earnings. Cash and net income. When comparing the 2009 annual report for 3M versus information obtained from a well-known financial website, we can see that the figures for 2009 cash are the same at $3.04 billion. Net income for 2009 is also the same at $3.2 billion. Here there is no discrepancy between the sources of information, but slight discrepancies are common. These discrepancies can be due to rounding, reporting method, typos, and the like. But in this case, the information is an exact match. So most likely, the reporting method was the same. For instance, billions of dollars reported versus millions or thousands. Here they use the same figures and the same calculations. MSN.com ratings and estimates. From Money Central on MSN.com, we can see that 3M has a stock scouter rating of 7 out of 10. This comes from having consistent price, neutral earnings, and a recent lower quarterly earnings per share. Also, insiders or ownership. 2 of the executives recently sold a small number of shares, and they were given a D grade for this, which contributes to the overall stock scouter rating of 7 out of 10. Recent earnings estimates for 3M show a Q1 earnings per share of $1.66, indicating a 4.53% growth year over year. For comparison, when we look at Johnson & Johnson, they have a Q1 EPS of $1.42 with a 3.43% growth year over year. In this case, 3M is the better stock. Earnings estimates continued. We have here a table that shows 3M versus its industry and the S&P 500. It looks at the last 5 years, 2013, 2014, and also the next 5 years. From the table, we can see that 3M's EPS is larger than the industry, but tapers off in 2014. We can also see that 3M's EPS is larger than the S&P 500 all the way through 2014. 3M is in a great position compared to its industry and the S&P 500. Cash flow trends, 2008 to 2012. When looking at the statement of cash flows, we can examine net cash from operations, from investing, and from financing. The trends that were apparent here for net cash from operations was a steady, slow uptrend. In 2008, there were $4.5 billion in cash from operations, and in 2012, there were $5.3 billion. Net cash from investing. The trend here is steady around $2.5 billion. There was a drop in 2009 to $1.7 billion. In 2008, net cash from investing was $2.4 billion. In 2012, $2.7 billion. The drop in 2009 here was probably due to residual effects from the financial crisis of 2008. Net cash from financing. The trend here is steady around $2 billion. There was a spike in 2011 all the way to $3.7 billion. In 2008, net cash from financing was $1.7 billion. In 2012, $2.1 billion. The spike in 2011 by nearly $2 billion most likely comes from retiring stock, and the other reason here could be that in 2011 3M did not take on new debt, therefore the resulting spike. So in conclusion, 3M is a good company with sound management. They have recently seen lower earnings and slow growth, but this is due to the financial crisis of 2008 and the ensuing weak economy. Their problems are not inherent to the company. They are an industry leader and will most likely continue to lead in their industry. Thank you for listening. Goodbye.